Commodity Markets. I'm joined by Jonathan Barrett, Managing Director with Commodity Broking Services. Jonathan Barrett, welcome to the program.
Good morning, Whitney.
So let's start with the price of gold, that drop, giving up about 12%. You predicted it would lose ground, but by this much?
No. I mean, yesterday was just a phenomenal day for us. The market traded for the first time over $116 during Asian trading, and that's something we've never seen, or I've never seen anyway.
It's interesting, isn't it? Because usually gold is the safe haven. So we're seeing it being sold off. Is that largely because people are trying to cover their losses?
Look, there's a couple of things, but we've pinned it down to about three things. The first thing is people moving to cash because of the uncertainties in Greece or in equity markets. The increased initial margins. Now, we had the same thing that occurred in silver not so long ago. So we think that's also part of it. And also the strength of the US dollar. It's the US dollar's new-found safe haven status has seen investors buy the dollar and sell commodities, and because gold's in that basket, down she comes. So I think it's just three main reasons as to why gold came off and why it came off so fast.
And what about these issues in Europe, the volatility there? As those problems extend, will we see further drops?
Look, I don't think so. Now, when we looked at 2008, when the GFC first started, gold actually came off $200. And then as we came into October, it started to pick up. Then all of a sudden people started to realise, hang on, we've got to go back to security. So I think this is just more of a blip. I think it's more of a clean out of everyone. And now the market has some good fundamentals now to continue to move on. And the fundamentals are still there. They are, and it's mainly coming out of Asia and India because their demand still continues to increase. India, last quarter demand up by 16%. China up by 17%. So it's still a good story.
Is the volatility, though, also linked to, say, the fact that it is quite a liquid asset class?
Yes, it is. What you find is that people, and this has been one of the big changes in the market, with the massive growth of ETF investments, people are saying, okay, let's go into gold, it's nice and safe. All of a sudden, hey, we need cash. So what's the easiest and quickest way? Where they know there is liquidity, and that's how they start to sell. So all of a sudden you've got this steady stream of sellers based on those people liquidating their ETFs, right, and moving into cash or into other asset classes. So that will keep in the market a steady range or a steady amount of sellers always looking to cash up when there are concerns out there in the global economy.
And of course we're talking specifically at the moment about the spot gold price. However, what sort of impact does this have on gold producers and gold stocks?
Look, the gold stocks have been all hit quite dramatically, just purely because Australia was obviously at the front of the markets when it all fell. So I actually feel that there's still certainly a lot of growth forecasts for gold, so I actually see this as an opportunity for people that want to get involved in those Aussie producers, that they can actually do so. I still feel that this is just a big blip in an overall bull market.
Now, that much touted $2,000 an ounce by the end of the year, it seems like a distant memory.
I think so. 2000, I think it's on its way still. Right,
but by the end of the year?
Not by the end of the year. It's still got to do a lot of work in order to get to that level, but I think it'll eventually get there. I think that moving forward, when you look at supply and demand, remember there's only about a 3.6% differential between demand and supply. So all you need to see is just a little bit more increase in demand, and it'll move higher anyway. Well,
we're sitting at just under $1,600 an ounce. So where in the near term do you see it sort of solidifying at?
Well, at the moment we've got a nice range. $1,760 on the top side, $1,530, which was the low yesterday, on the downside, and I think you'll find the market will buy the dip. So I think anything sub $1,600, the market should be well supported.
And you mentioned silver just briefly before. It also dropped $30 an ounce. Is that just tracking what happened to gold?
It is, but I think it's not as liquid. And also I find that the movements for silver on the downside are always exaggerated, and they're certainly very volatile and violent. Another example was obviously the last 2 days where we dropped so dramatically. It'll find its own. Remember, silver is an industrial metal, so once you do see a little bit more uptick, a little bit more confidence coming back to the market, you will find they'll come back to silver as well.
Let's move on to the other commodity that's making news, and that is oil. Now, the price, there's been a lot of volatility there. Both Brent and NYMEX have made ground. What's your view on this?
I think crude oil has been in a range for a while. The last couple of trading sessions, it's obviously that confidence in the market, confidence in Europe and America not there, so it's come under an enormous amount of pressure. 77.50 was about the low. Now it is interesting, OPEC start to come out anywhere sub 80. So if in fact we see the price remain below 80, you'll find OPEC will start to come out and say, hey look, it's a bit of a concern here, we can't see oil prices too low. Now the good thing is that oil has bounced back from that. We're trading at 81 at the moment, so if anything I think we have a double bottom in play already down near that 75, 77. So I would think now, given that we get these positive packages through from Europe, that you'll find there'll be some good support for oil as well.
So basically OPEC is just playing a waiting game at the moment?
I think they are. I think they also understand that generally having weak prices is good, but not too weak is an issue.
Now, the other issue, though, is that there's this volatility in the oil that's affecting the petrol price. Can you just explain why that is? Well,
it is quite interesting because a lot of people always ask the question, with oil coming down, why aren't we getting it at the petrol pump? And it is one of those things
that's a fair point.
Yeah, and when you see it come down, you expect it. But oil prices or the petrol pump price looks like it will be trading higher. Now, the main reason for that is Australia imports 75% of its oil needs, which seems crazy when you've got about 3.18 billion barrels of reserves. But we do, and as the Aussie dollar starts to come under pressure, because we're importing, that bit hurts us a little bit more. So the more the Aussie is actually weak, the higher the price we'll pay at the petrol pump.
If we just look at the commodity sector broadly, there's been some sort of news that suggests that the sector has risen off the back of some speculation by those plans by the G20 finance ministers. Does this indicate that, there's a recovery in risk assets?
Look, I think there's a recovery. I think when you look at what G20, when you look at what Europe are also, or the European ministers are all trying to achieve, they're just trying to achieve stability.
Which is a very hard thing to do at the moment, Jonathan.
Look, it is. It is. And this is why this might go long for such a long time. And this is also why the US dollar is in New South Haven, because people can't go anywhere else. But what you will find, once we see that there is light at the end of the tunnel with what's happening in Europe, that'll only provide confidence for the market to come back to where it should be. And we do see that growth in the commodity sector. That bull rally that we always talk about, it's still intact. It's just that it's having a rest at the moment.
Jonathan Barrett, thanks for joining us.
Thanks, Whitney.